Understanding return on capital employed, ROCE. Return on capital employed, ROCE, is an essential financial metric that assists in evaluating the profitability and efficiency of capital utilization within a company. This ratio is crucial for financial analysts, stakeholders, and potential investors, providing insights into how effectively a company is leveraging its capital to generate profits. Key takeaways. Definition: ROCE measures a company's profitability relative to all of its capital. Comparison: it is similar to return on invested capital, ROIC, but assesses a broader range of capital. Industry relevance: comparing ROCE among companies within the same industry helps to neutralize variability due to industry-specific capital structures. Investment indicator: a higher ROCE is indicative of a more profitable company, making it attractive for investors. The ROCE formula. The formula for calculating ROCE is \text ROCE equals \frac text EBIT text capital employed where EBIT equals earnings before interest and taxes. Capital employed equals total assets, current liabilities. Calculation of ROCE. 1. EBIT calculation. This figure represents a company's operational profitability, akin to operating income. It is derived by deducting costs related to goods sold, COGS, and operating expenses from total revenues. 2. Capital employed calculation. This is calculated by subtracting current liabilities from total assets, giving an overview of the funds used in the business, i.e., equity and long-term debt. 3. Average capital employed. Some investors may calculate ROCE based on the average capital employed over a specific period to smooth out fluctuations and get a more stable view of performance. Significance of ROCE. What ROCE reveals. Profit generation. ROCE indicates how much profit a company generates for every dollar of capital employed. A higher ROCE suggests better profitability and operational efficiency. Comparative analysis. This metric is particularly beneficial for comparing companies in capital-intensive industries, like utilities and telecommunications, where significant investments in fixed assets are required. Time series analysis. Investors favor companies with a stable or growing ROCE over time, suggesting improving operational efficiency and profitability. Limitations of ROCE. Despite its usefulness, ROCE has its drawbacks. Sector variation. Due to differences in capital requirements across various industries, ROCE may not be directly comparable across sectors. Profitability focus. While it provides insights into profitability, it overlooks other essential financial performance measures like revenue growth and cash flow. Historical limitation. As a historical measure, it may not accurately predict future performance or capitalize on current market opportunities. Manipulation risks. Companies may engage in financial engineering to artificially inflate ROCE figures, making it essential to approach this metric with caution. Improving ROCE. Companies can enhance their ROCE through various strategies. 1. Operational efficiency. Streamlining processes and eliminating unnecessary costs through automation and lean management can improve profit margins. 2. Strategic capital allocation. Prioritizing investments in high-return projects ensures better utilization of capital. 3. Asset optimization. Maximizing returns on existing assets, renegotiating contracts, and divesting underperforming assets can help increase the capital efficiency reflected in ROCE. 4. Focus on revenue growth. Employing strategies aimed at expanding market share or innovating products can lead to higher sales and, consequently, a better ROCE. 5. Talent development. Investing in employee training can improve efficiency and productivity, ultimately impacting profitability positively. ROCE and economic cycles. ROCE is influenced by the economic environment, often showing different trends during various phases of the business cycle. Expansion phase. Increased demand leads to higher revenues and profits, often boosting ROCE. Peak phase. Competition intensifies, and while profits may remain high, ROCE may stabilize or decline due to decreased growth rates. Contraction phase, economic downturns usually lead to reduced demand and profitability, resulting in lower ROCE. Recovery phase, companies that manage expenses and adapt to market changes may see a recovery in ROCE as demand and sales start to rise again. ROCE versus ROIC. While both ROCE and return on invested capital, ROIC, measure the efficiency of capital utilization, they differ in their calculations. ROIC formula. \text, ROIC equals \frac, text, net operating profit after tax, text, invested capital, Invested capital includes a comprehensive analysis of a firm's total assets and obligations, often providing deeper insights into capital efficiency. Example of ROCE in action. Let's compare two companies, ACE Corp and Sam & Company, within the same industry to illustrate ROCE application. Company EBIT total assets current liabilities capital employed ROCE. ACE corporate $500,000 $2 million $500,000 $1.5 million 33.33%. Sam & Company. $300,000 $1 million $200,000 $800,000 37.5%. In this hypothetical scenario, while ACE Corp has a higher EBIT, Sam & Company shows a better ROCE, indicating it is generating more profit per dollar invested in capital. Conclusion. Return on capital employed is a vital financial indicator that helps stakeholders analyze a company's profitability and capital efficiency. By understanding its calculation, significance, advantages, and limitations, investors and managers can make well-informed decisions. Continuous monitoring and optimizing ROCE can lead to improved financial performance and healthier capital investments, making it a critical aspect of strategic business management.